Okay, so I guess the easiest way to learn anything about accounting and finance and make the information manageable is to try and make the content as relatable to your day-to-day business as possible. So I will try and use as many day-to-day relatable examples and terms as possible. Finance and accounting can sometimes be a little bit tricky to get your head around. So I think the best approach is to try and keep things relatively simple, but then with the option to build on your learning via the relevant resources. So I have included some additional resources within the resources list of this lecture series. So go and have a look at what I'm advising or what I'm advocating for you to use as a way of improving or kind of furthering accounting and finance knowledge. Okay, so I will start by way of the key terms then. So some basic accounting terms that you must know if you want to engage in accounting and finance in any way, shape or form, as far as your business is concerned, is, so number one, proprietor. So proprietor is, by definition, is a person who invests the money or things in the business. This person is called a proprietor or owner. So the way that I think of proprietor is that it's the person who has kind of the say over the business. So we often talk about a sole trader or an entrepreneur as a proprietor, or what they have in terms of the business that they run is a proprietorship. So a proprietor is simply that it can be, you know, it's gender neutral. It could be man or woman, but it's just a person who has responsibility and kind of say over the business as an entity. Then income by definition. So income, which is, okay, so in simple terms, income is just money coming in. So money that comes into the business. And I say in simple terms because income, I mean, you could have money coming in that isn't by definition income. So an example of that could be a loan. If you took a loan out, a business loan to help you grow your business, that technically is not income because you still have to pay it back. Okay, so that would actually be a liability. That would be something that you have to pay back in the future. So examples of income would be money that comes into your bank account, money that comes into the business's bank account, maybe every month via sales, or, you know, credit, payment of credits that are owed to you. These would be income. So money that comes in to stay in. It's not something that needs to be repaid. Then, so number three, expenses. So it is the opposite in some way, shape or form of income. So expenses is typically money going out of the business. Okay, so we often call expenses overheads. So you might hear, especially if you work with an accountant, you might hear them referring to your overheads. Overheads are just expenses, things you have to pay month on month or week on week. And it's by definition money that goes out of the business. Okay, then we move into profit. So this is one that I'm sure every business owner understands, because the whole purpose of you running a business is to turn a profit. Okay, unless you're not profit oriented, but if you are, then the whole purpose of you existing, the business existing, is to make profit. So profit is a financial gain, especially the difference between the amount earned and the amount spent in buying. So this could be, you know, your operational costs, your costs of goods sold. It could be your cost of services rendered. Okay, so it's the cost that you have incurred in order to deliver the service or to produce the product. So profit is basically everything outside of that. And then revenues. So revenues by definition is, it's a sort of income, and we often refer to income synonymously with revenue, although it's not the same because you can have different types of revenue. So all sorts of income received into the business is called revenue. So examples include, again, sales. If you are, you could be selling products or services. So sales, commission maybe that is owed to the business or owed to you within the business. And then interest payments could be another example. The interests that are paid into the account. Okay, then we move into the final definitions. So we have here cash flow. So cash flow, okay, so if you're new to business and you're new to finance, cash flow is something that we in the world of accounting and finance, we talk about cash as being king. And cash also is referred to as the lifeblood of the business. So cash flow is something that we would deem integral, important, key, super necessary. You know, you have to have cash in your business. So cash flow is basically income into your business, less outgoings, and less also credit agreements. So it has to be the cash that's flowing through the business. Where you have a negative cash flow, it's because what's come into the business is less than what is actually going out of the business. Yeah, so cash flow is just, it's just like it's cyclical. It's the cyclical, so the cycle of cash coming in and then being spent, going out of the business. Loss, so we often talk about profit and loss. So loss is when the expenses of producing your goods or rendering a service become higher than the revenue that is being incurred. Then your business will be turning a loss. You'll be making a loss or a negative profit, with negative growth, negative profit, but loss. So where the business is spending more than it's earning, then we would see the business then at a loss. And then the final two key terms that are often used quite heavily in accounting and management. So the first one is accounts payable. So accounts payable is a person from whom a business organization or individual needs to, so it's a payment that needs to be made from the business to a person. Okay, so your accounts payable is anything that is payable to another entity. So for example, especially businesses that produce products, you are likely to have suppliers. So where you're selling a physical product, the chances are you've sourced that product from a supplier, or you've produced the product yourself, but you've sourced the component parts or the raw materials from a supplier. So accounts payable could be the invoice that you receive month on month from your supplier. Whereas accounts receivable is basically anything that's owed to you, to the business now, to the business owner. So for example, a person to whom goods are sold and on credit, by definition, is now owing the business. And so we would then enter that amount in the accounts receivable section of a financial statement to indicate that these are the amounts that we still need to receive from whomever it may be, from a customer. So accounts payable, what you need to pay out, and accounts receivable, what still needs to come in. Okay. So now that we've got the key terms, let's go into a kind of a conceptual breakdown of what accounting is. So conceptual in the sense that it's a concept. So how do we understand it conceptually? How do we understand the idea? So what is accounting? What is it all about? Well, by definition, accounting concerns activities, any activity related to collecting, recording, classifying, and summarizing of the business transactions, and then finally preparing the financial statements. So accounting is an organizational function. It helps the business to organize its any information that is related to finance, to money coming in and out of the business. So it collects the accounting department or function will be responsible for collecting all types of financial information, recording that information in financial statements, and classifying the information. So for example, do we classify it as an entry into accounts payable or accounts receivable? When we produce our financial statements, would we classify it as an asset or a liability? And don't worry if you don't know what that means at this stage, because I will define some of these terms further on. But accounting is that it's an organizational function, and it helps the users of financial information. It helps them to engage with the information just in an easier way, in a more efficient way. So it puts the information into a digestible, kind of presentable format that then can be used, to build a narrative. And then the basic purpose of accounting is to provide decision makers or users of financial information with the information that they can then use to make economic decisions moving forward. Okay, so as far as an accountant is concerned, and I know that many small business owners will use an accountant. Now, I'm not here to tell you whether you should be using an accountant or not, but I would personally advocate for the use of an accountant where in the instance that you yourself are not an accountant, or you yourself don't have a financial background, so either an accounting or finance background. In that context, I think there needs to be some expertise brought in and bought in. So accountants are more concerned with this information. How can we budget? How can we budget this type of information? How can we prepare this type of information for audits? Taxes. What taxes are due? What taxes are payable? And can the business still operate in spite of needing to budget certain amounts and pay certain taxes and so on? Whereas financial analysts are not the same. So accounting is one thing, and finance is another. So financial analysts are typically experts in financial products. So they are experts in the types of financial products that are available to the business or to individual investors, right? So if an individual investor wants to invest in, say, for example, a corporation, maybe a public limited company, then a financial analyst would probably be the intermediary to give the potential investor some more information as to what can be invested in, why it's a good decision, what the health of the business looks like. So either it's financially healthy or it's not financially healthy. And I guess so the key question is, where does finance and accounting come in? For a small business owner or small to medium business owner, where does finance and accounting come in, and how many times does it come in? Because the reality is it's likely to come in more than once. Okay, so my answer to that question, I asked it, so I'll answer it. My answer to that question is it directs the course of the entire business. So it comes in everywhere. In simple terms, it comes in everywhere. It directs the course of the entire business. And so, I think it's just really important that Even if you don't have an accounting or finance background, you understand the basics of it, and B, where you don't have a background, you are getting the expertise in. Okay, so here on this slide, I am highlighting the different roles of, again, of accounting and finance and accounting to the organization. Okay, so organizational activities around finance and accounting will differ, determined by, you know, what the information is being used for. So what the purpose of the information is. So the first key role or function of accounting information is to record the financial consequences of organizational activity. Okay, so, you know, by that, I mean, for example, you know, bookkeeping, where you would just simply enter data into, you know, a spreadsheet, or a kind of a database maybe, or an online accounting platform. These days, thankfully, there are online platforms that do this for you. But accounting at one end is simply about, you know, data entry and collating information and organizing information, so that it is usable, right? So that we can do something with it. Because we all know that, you know, I run a business too. We all know that if we don't keep on top of our taxes, or we don't keep on top of our, you know, a profit and loss statement, or money in, money out, it can get really confusing. What have you spent? What haven't you spent? It can get really confusing. So that's the first function of accounting information. Now, the second one is for compliance purposes. And if you are not registered, then I guess this is the point at which you can maybe switch off. Not altogether, but just for literally a number of seconds, because compliance is, it's all about meeting requirements of governmental regulations. So where government are implementing policies and regulations around corporations, you know, limited companies, public limited companies, yeah, there is need to then comply, right? So in other words, as part of compliance, a company will need to conform to the rule, such as specification of your kind of financial data year on year, or each financial period. Also, you know, comply to policy, comply to certain standards or law. And so this information needs to be prepared for compliance. And also, you know, I say that maybe you can switch off if you're not registered, but actually no, maybe I shouldn't have said that, because there is, you know, SMEs, whether you've registered your business or not, SMEs are still subject to auditing. Now, it's less likely. It's, you know, the propensity of population tends to, of auditing tends to occur more with your corporates, but this doesn't mean that SMEs are exempt. So actually, yeah, compliance is one that we all need to consider, really. And then the third point is management and control. So as a manager, as an owner, as a manager, you produce financial statements in order to monitor what's happening. So you can see what has been spent, expenditure in certain departments, or expenditure over time. You can compare year on year. How are we doing in terms of our budgets? Are we over budget? Are we on budget? Are we, you know, what's happening? Costs going up? You know, what is happening? So operationally, you keep in control of your spending, and you keep in control of, you know, your employees, if you like, because the chances are where there are, you know, I'd say more than 10 employees, it now becomes hard to monitor, you know, across the board spending, and so these statements help to do that. Okay, number 4, strategy and risk. So we already know that strategy is key. So for anybody who runs a business, strategy really is the starting point. It's the, you know, the unique position that you want to obtain in the market, in your respective market, and you do this by outlining the strategic steps that you will need to take in order to get to this place of unique advantage, right? So you want to gain a unique advantage over your competitors in some way, shape or form. And so money comes into this, finance comes into this, to develop and implement strategy and manage risk. We need to do this from not only from a strategic perspective by way of analysis and decision making, but also from a financial perspective. We need to consider what is it going to cost, or what is the implications for money in and money out as far as our strategy is concerned. You could choose to pursue a low cost strategy, or, you know, a high risk strategy, in that, you know, you're spending quite a lot on something that isn't secured or has a high element of risk. And so these are the things that you need to consider. Then the final role or function, as far as finance and accounting activity and information is concerned, is funding. So especially for business startups, because by definition, if you are a startup, then the idea is that you've started with the intention to scale your business, to grow your business, and to grow your business, you know, consistently and efficiently over a certain period of time, a certain number of years. And so you might require funding if you fall into this category. You could require funding if you don't fall into this category, but where you need funding, there is the need then to inform funders of your plans and your intentions. You need to build a business case and engage your investor, or engage your potential funder. And so they will need to know your current the business's current financial position, past positions, and potential future positions, how the health of the business will look and how the health of the business will improve over time. So this information is needed for the purposes of speaking to funding bodies or funders. Okay.